Ladies and gentlemen, traders and investors, a very warm welcome to our channel Polo Vega. On today's video presentation, we shall continue with different option strategies that we've been talking about for the past 1 month or month and a half. On today's video presentation, we shall explore more exotic options, which shall be the four-legged Condor option strategies. We shall talk about the long, the short call Condor options, and the long and short put Condor options, and finally we shall talk about the iron Condor strategy. But before we move on to discussing these option strategies, we shall also talk about the events and the charts that were in demand during the week that has gone by. Friday was a very big day in the US market when the inflation reports and the job reports came out very bullish. The non-farm payroll report, as well as the unemployment change and the job earnings report, came out extremely bullish, leading to high inflation expectations during the second half of the year, and this led to a sellout of both bonds and shares. On today's video, we shall talk about XAU/USD, which is the gold-based ETF. Then we shall look at the US oil spot. We shall look at Nasdaq and S&P 500. And finally, we shall look at the US dollar decay, as well as the Indian index Nifty. The contents of the presentation are for information purposes only. The material is being obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 45th of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on analysis of the market. We do not advise, recommend, or guide anyone to take any trade based on the contents of this video, and we do not take any responsibility for partial or total losses arising out of trades based on the contents of the video. The chart that we see on our screen is that of Dixie, which is the US dollar index, and we're looking at the daily chart. As we've been visiting this chart for the last couple of months and have seen the index to be range bound, we can see that last week it printed a series of rally-based rallies, and the candle printed on Friday was an explosive one, breaking out of the 99.99 area, and we could see a break above the range, which is at 100.39 anytime during this week if the US dollar index continues to climb up on Monday, Tuesday, according to the revised expectations of the market. This could be a chance of a breakout above the range that the US dollar has been following since April last year. The stronger the US dollar index, the stronger will be the fall in the other markets like the Nasdaq or the S&P, which are the stock market indexes, or the male market like gold, silver, platinum, copper, nickel, and the others. So this rise in strength of the US dollar could reflect in a weakness or fall in the metals market, the commodities market, and of course the stock market as well. One needs to wait and see if the continued strength of the US dollar can be revised if there is a clear decision of the negotiations going on between Iran and US over the Strait of Hormuz and the ceasefire that has been violated many a times during last week. The chart on our screen is that of NQ, the Nasdaq based ETF, and we're looking at the daily chart. Nasdaq had been bullish all this while until it registered a very strong drop on Friday of last week under the influence of a strong and bullish jobs and employment data, as well as revised expectations on CPI and PPI for the previous week. Both the shares and bond market went into a free fall after the revision of expectations of traders and investors about the rate cut decision that could get delayed all the way until the end of 2026 or beginning of 2027, with revision in the yield expected from bonds and the inflated value of assets. The market decided to go for a sellout on both S&P as well as Nasdaq. On Nasdaq, we had marked a demand area in our last presentation, which is between 28647.58 and 29153.75, and as of now we can see that this zone is in play, and if we wish to go long, we must look at the lower time charts to see if there are any signs of reversal or not, because if there is no sign of reversal, then it could print some dojis to go sideways and then again drop further. Therefore, if we wish to go long, we must look at the lower time frame charts like the 60-minute chart, and we can see that it has printed all red candles on Friday, right from the beginning of the session all the way until the close of the session. We still need to wait and see if it prints some green candles which could engulf the old red candles printed on Friday to show signs of reversal. Otherwise, we will have to wait before going long on this index. The chart on our screen is that of ES, which is the S&P 500 based ETF, and we're looking at the daily chart. S&P, similar to Nasdaq, had been bullish right from the announcement of ceasefire between Iran and US, and it was not as strong as the Nasdaq, had registered a drop about 2 weeks ago with a drop-based drop followed by all green candles during the last 2 weeks, and this week once again it has managed to print a drop-based drop right into the demand zone that we had marked in our video presentation last week, which is between 7357 and 7399. However, one needs to see if there is a reversal or whether the fall is going to continue under the influence of a strong dollar and revised expectations of the market about Fed rate cut, which could go all the way to the end of the year or maybe beginning of next year. Also, there are people who are looking at a rate hike as well because of the strong jobs data that was printed on Friday and the strong CPI and PPI reports that came out last week, revising the inflation expectations for the current year. Therefore, as of now, we should stay on the sideline and watch on the lower time frame charts if the market is going to show any signs of reversal. As we can see that the index printed a series of red candles on Friday, and it closed without any signs of reversal on the 1 hour chart. One can expect a further drop on Monday after a revision of the strength of the US dollar by the participants of the market. Therefore, please wait and watch out for the formation of a strong green candle if you wish to go long. Otherwise, we shall have to wait to go for a short. The first area for going short could be between 7511 with a stop loss at 7518 on the hourly chart or anywhere above this particular area. Also 7534, which was the previous low on this chart, and this could provide a nice resistance for going short on this particular index in the forthcoming week. The chart on our screen is that of US oil spot, and we're looking at the daily chart. We've seen that the US oil has shown a lot of strength in the past few weeks after the commencement of the war between Iran and the United States of America. It managed to go sideways for a bit after the announcement of the ceasefire between the two countries, but since the two countries have not been able to come to a final negotiated decision, the energy asset has been seeing a lot of strength on every failure of negotiation between the two countries. It printed a rally-based rally in the beginning of last week, and that was followed by a drop, followed by another drop on Friday. So Thursday and Friday it printed red candles, while the first 3 days it printed blue candles. One can see that the candle between 88.5 and with its wick touching 79.58 has been providing a strong buyer's area and has been managing to give a lot of bounce off this particular demand zone in the past few weeks. As of now, it's still closed at 88.56 on Friday, and one needs to see if the energy asset can take out the buy orders between 85.7 or 85.5 and 88.5 to go down further for the first time since 20th of April 2026. Its recent low was a wick that touched 78.94 on 16th of April, after which the asset class has stayed above 85.5 in the last 3 to 4 weeks. The chart that we see on our screen is that of XAU/USD, which is the gold-based ETF, and we're looking at the daily chart. Gold has been bearish right since the commencement of the US-Iran war. It did go up on the first day of the war, touching 5412, and then it fell all the way to touch 4093 on the 23rd of March. There it established a nice demand zone from the bounce of this 4100 area all the way up to 4513, and ever since then it's the first time that gold has visited this area and managed to close within this area at 4315 on Friday of this week. Gold has been bearish, but the candles printed were not very explosive up until the one that was printed on Friday of this week under the influence of the strong jobs data released on Friday, and the CPI and PPI data that were released during the week. This has confirmed the continued strength of the US dollar, basis which most of the commodities, metals, indexes, and the shares and the bond market had a free fall on Friday. Now one needs to wait and see if the US dollar shows further strength, or if it weakens, giving a chance for these metals as well as the shares and indexes to turn around. But we still need to see how does the metal behave on Monday and Tuesday before we take a decision to go short, which could be at 4432, or if we were to go long, we need to see the formation of a nice demand zone anywhere at 4300 or below this area, depending upon where does the drop come to an end after the revised strength in the US dollar. The chart on our screen is that of Nifty, which is the online index in India, and we're looking at the daily chart. It's based on 50 stocks from the NSE, and this particular index is like the Nasdaq of the Indian stock market, but it has been behaving very differently from the behavior of Nasdaq, which has been showing a lot of strength ever since the ceasefire between US and Iran was announced, and the strength has been on the back of investments in the AI based companies in the United States of America, which is not the situation in India, because in India the rupee has been very weak and the Indian government has been struggling to support its forex reserve based on the investors pulling out of the Indian stock market and their investments in India. The government has injected some strength recently into the rupee through its policies from the Reserve Bank of India, and we need to wait and see if the austerity principles laid down by the government of India could help the rupee gain some strength, and also if it could inject some strength into the Indian stock market. But as of now, we can see that it has been struggling to find strength over the last 4 to 5 weeks. Right from the beginning of May, it has been printed more of red candles than green ones, and even on Friday it printed a red candle, but it was not as big as or as explosive as the candle printed by Nasdaq on Friday. So we'll need to see if this index follows the Nasdaq and prints an explosive red candle on the opening on Monday. Traders and investors, we shall now start with the discussion on the four-legged Condor option strategies. Condor option strategies are based on different options, either call or put options, being bought and sold at the same time. They are basically very useful during low volatility as well as neutral market conditions when the underlying is in a range bound movement. In case of a long Condor core option strategy, we first buy the core option with the lowest strike. We then go on to sell the next two strikes, and finally we again buy the highest strike core option. The strategy stands to make the highest profit when the underlying is between the inner strikes or close to the inner strikes. As soon as the volatility starts moving up, or if the underlying starts moving either towards the lowest strike or towards the highest strike, the profit potential of the strategy starts going down, and the maximum loss occurs when the underlying crosses the outermost strike prices, which are the highest and the lowest of the call options that were bought. Therefore, the whole strategy believes that the market is going to stay neutral and the volatility is going to stay low during the life of the strategy. It is also known as a stretched butterfly because of the reason that it's got a wider potential or profit potential as compared to the butterfly option strategies. We now come to the short Condor core option strategy. In the short Condor core option strategy, we sell the lowest strike core option, we then buy the next two strikes, and then again sell the highest strike core option. It's the reverse of the long Condor core option strategy, and it works in a reverse environment where we expected the volatility to stay low in case of the long core Condor option strategy. In case of the short core Condor option strategy, we expect the volatility to stay very high so that the underlying stays outside the outermost strike prices. Either it stays above the highest strike price or it stays below the lowest strike price, and thus it's a net credit strategy where we manage to get a net credit by selling the outermost strikes and buying the innermost strikes. We always want to retain the credit that we've received, hence allow the option to expire worthless, and that's why the strategy works best when the underlying stays outside the outermost strike prices. Therefore, we do not want the volatility to fall and allow the underlying to reach the inner strikes in case of a short call Condor option strategy. We now come to the long put Condor option strategy where we buy the lowermost strike put option, we then sell the next two strike put options, and we finally buy the highest strike put option. The structure of the option strategy using put is exactly the same as using call options. Also, the profit price diagram is exactly the same, and the whole strategy works in the same way as that of the call options. Here, the maximum profit occurs when the strike price or the inner strike prices are close to the underlying price. As soon as the underlying starts going up, or if the volatility of the market goes up, then we start to lose money, and the highest loss or the maximum risk is when the underlying stays outside the outer strike prices, which are the lowermost or the highest strike prices. It works best in a neutral market when the volatility of the market is low and the price is absolutely range bound. There's no difference as such between the long call Condor option strategy and the long put Condor option strategy because the structure is the same, the volatility conditions required are the same, and also the profit price diagram is identical for both these strategies. We now come to the short put Condor option strategy, where we first sell or go short on the lowest strike put option. We then buy the next two strike put options, and finally we sell the highest strike put option. The strategy is a net credit strategy as we receive premium on the shorts on the lowest strike put option and the highest strike put option. The strategy is profitable when the underlying stays above the highest strike price or stays below the lowest strike price. Once the underlying starts moving towards the inner strike prices, we start to lose money on this particular trade. But the risk is limited to the difference between the two strike prices, which are the lowest and the highest, less the net credit that we receive from selling the premiums on the options that we have gotten short on. The strategy works best when the volatility of the market is elevated and the underlying stays above the highest strike price or below the lowest strike price. Traders and investors, we now come to the last leg of our discussion on Condor option strategy. The strategy that we now going to talk about is the iron Condor. It's a combination of a bear call strategy with a bull put strategy. In other words, what we do is we first sell an OTM call option and we then buy a further OTM call option which is a higher strike price. We then sell an OTM put option and we then cover our position with a lower strike price put option. The strategy believes in the market to be neutral and the volatility of the market to stay low for as long the trader is in the trade. If the vega or the volatility of market goes up, then the trader stands to lose from this trade. The idea is for the underlying to stay between the strike prices of the short call and the short put. Once the underlying starts going above the strike price of the call option or below the strike price of the put option that was shorted, then the trader stands to lose money. One needs to be very careful in these strategies or the four-legged strategies purely because they depend on, number one, the selection of the strike prices, number two, the volatility expected by the trader when he's getting into the trade, and number three, the time decay, which works in favor of the shorts but it works against the longs that we get into. Thus we come to the end of different kinds of Condor option strategies, and we shall get into talking about butterfly strategies in our next presentation. Traders and investors, we hope that you found our video presentation informative and exciting enough for you to come back and watch all our videos. We now come to the conclusion of our presentation on Condor option strategies and different events that took place during the previous week. With regards to option strategies, we'd like to highlight that no matter how many ever legs does the option strategy have, they are basically a combination of different kinds of bull or bear, call or put spreads, and one needs to be having a very good understanding of the selection of strike price, time decay, and the change in volatility conditions during the life of the trade. We must always know how to manage our trade before entering into a trade. We must have a strategy to manage the trade if it doesn't go in our predicted direction, or even if it follows our speculated direction, then we should know when to close the trade or allow the trade to run to the expiry date. We hope that you've been enjoying all our videos so far, and we wish you all the very best. Have a good weekend. Please visit us at our website www.polovega.com or get in touch with us at Twitter handle @polovega. Please like, share and subscribe to our channel Polovega.